When global tensions flare, like the June 22nd strikes on Iran's Fordo, Natanz, and Isfahan nuclear sites, investor behavior changes in real time, and capital flows shift dramatically.
On the conflict between Israel and Iran, or at least hopefully not soon.
In those same hours, Bitcoin tumbled over 4%, dropping from about $104,000 to just under $99,000, as leveraged positions were liquidated across Binance, Bybit, and OKX Ethereum. Solana, Cardano, and XRP followed suit, plunging 8 to 12% intraday.
Stay down, yes. So for altcoins, it was double. It was about 12%.
Roughly $720 million in long positions were wiped out, underscoring the speed and depth of the move.
Best thing I can do in advance is to warn you of these liquidation levels.
By contrast, gold and the US dollar surged. Gold by nearly 1%, US dollar strength across key indices, highlighting their continued role as classic safe haven assets. This divergence between crypto chaos and traditional calm spotlights a fundamental question. In wartime, where should you deploy your capital? Into the riskier upside of crypto, the stability of gold, the liquidity of cash, or some combination? Here is a comprehensive, data-driven, and market-aware breakdown. US dollar strength is the immediate fallback in geopolitical crises. On June 22nd, the dollar index rose around plus 0.12% as markets sought liquidity and security. Why does cash win in a war? 3 reasons. Liquidity. Cash is instantly available for essentials, rent, moving assets, or emergencies. No exchange delays, no internet needed. Flexibility. Use it to buy dips in other assets or weather short-term cuts. Political stability. The USD benefits from safe haven demand, though it can face long-term inflation if conflict persists. Caveat. Cash loses purchasing power with inflation, and prolonged war stresses fiscal systems. But as a tactical base, especially in conflict, cash is essential. When war strikes, gold shines. It's tangible, globally trusted, and immune to cyber warfare. Following the Iranian airstrikes, gold climbed nearly 1%, reacting almost immediately to demand for a physical store of value.
I do foresee us needing to pull back just a little bit more into those key regions, hit those target areas. Once again, the fear is probably going to be a little high. News is going to be extreme at those areas. And then from there, we would look for the strength to come back in, and then a next leg higher overall in Bitcoin, which in turn is going to mean for the overall market, I imagine the stocks and traditional markets would come with it.
In the June 21st week, gold hit 5-month highs, even as equities and oil fluctuated.
Inflation rise in the countries that have their oil ships going from that place. And it is not just about oil then, it is about more or less every commodity, because if oil prices go up, that means the price of transportation goes up. And if the price of transportation goes up, that means anything, if even from a matchstick to a Mercedes, everything goes up.
Pros of gold. Time-tested safe haven across millennia. No yield pressure. In crises, preservation matters. Accepted globally in bank vaults and reserves. Cons. No passive income. Interest. Dividends. Exposure to storage costs, custody needs, slower gains. Unlike crypto's sharp rebound potential, crypto is volatile but resilient. During the initial sell-off, BTC dropped approximately 4% and ETH approximately 9%. But institutional flows, especially via spot Bitcoin ETFs, pushed BTC back above $101,000 within 24 hours.
Below $100,000 for the first time since May. Mackenzie Sigalos is here. She's got more on the move. Hi, Mac.
Hey, Morgan. So that's right. Bitcoin was trading below that key $99,000 threshold today.
This demonstrates that crypto isn't just for gains. It may now offer shock absorption via ETF liquidity. But crypto also comes with cyber vulnerability, as Israel-linked hackers wiped $90 to $100 million from Iran's Nobitex exchange days before the attack.
In a major cyber attack, hackers from a group called the Predatory Sparrow wiped out $90 million from Iran's largest cryptocurrency exchange.
This underlines a new threat vector. Crypto infrastructure is susceptible to war-induced hacks or blackouts. Pros of crypto: high upside potential, fast rebounds possible. Institutional maturity via ETFs, digital transferability across borders. Cons: extreme volatility, crash potential is steep. Digital infrastructure risk, hacks, blackouts, platform failure. Still perceived as a risk asset, not a primary safe haven. Most analysts advocate a balanced portfolio with a mix of USD/cash, gold, and crypto. USD cash 40 to 50%. Rationale: foundation liquidity and optionality for crisis days. Allocation tip: keep enough cash to cover 6 to 12 months of expenses. Gold 25 to 35%. Rationale: protection against inflation and systemic turmoil. Allocation tip: use ETFs or physical coins. Avoid high storage costs. Crypto BTC/ETH only 20 to 30%. Rationale: tactical upside if war sentiment turns and inflation bites. Allocation tip: use cold wallets or regulated ETF providers. Avoid leverage. In conflict scenarios, this mix allows for capital preservation, cash plus gold, with a growth tailwind, crypto, but with clearly defined risk controls. Investors should focus on these key metrics: oil prices, war disruptions, oil above $100, inflation spikes, demand for gold and crypto. Volatility index: a rising VIX suggests fear, creating both danger and dip buy opportunities. ETF flows: positive institutional inflows into BTC/ETH support long-term recovery. Crypto hacks or blackouts: cyber threats can trigger platform failures or regulatory backlash. Sentiment indicators: safe haven assets staying strong is signal number 1. Crypto strength is signal number 2. These indicators in combination can help tune portfolio tactically when conflict evolves. In 2022, during Russia's invasion of Ukraine, Bitcoin dropped approximately 16%, but quickly rebounded to new highs by 2023. Similarly, during the COVID crash of early 2020, gold squeezed upward while crypto dropped. BTC recovered faster than gold. The lesson: crypto is not a simulator. It's reactive, violent, but increasingly capable of bouncing quickly due to institutional buffers. War reshapes global markets in seconds. Gold and USD provide structured defense. Crypto offers growth opportunities, but only within risk-managed boundaries. If you're new, start with cash and gold. If you're experienced, add crypto carefully. Market tip: review asset allocations monthly during crises. Keep a buffer for sudden moves and never invest more than you're prepared to lose. If you found this breakdown helpful, like, share, and subscribe to our channel for ongoing analysis of war, finance, and opportunity. We dive deep so you stay ahead, right on or off the battlefield.